Tom, thanks for joining us today. Happy New Year to you. The idea of today is to flesh out the fiscal compact agreed at the beginning of December. Is fleshing out the compact enough for you?
No, and it won't be enough for anybody else either. I mean, it's a mere one part of a cocktail of solutions that need to be found. And as Linda said, the emphasis, the main emphasis of those solutions is really on labour market structural reform. It's not about agreeing on levels of fiscal deficits, which in extremis will not be held to. We didn't see the French and Germans hold to the limits in 2003. Why are they going to do it the next time they're under pressure?
Because this time's different.
This time's different. Told. No, the real thing we're looking for is those the unions and the professional groups to actually say, yes, we are going to be more flexible, we're going to be more competitive. And people say, but that takes time to come through. It takes time for the growth to come through as a result of that, and markets won't wait. That is wrong. Ireland has pushed through these sorts of reforms, and the bond market has rewarded it accordingly, along with very tight fiscal reforms as well.
How long does it take to implement these reforms?
It depends. You could say to the Italian drivers, right from next Rome taxi drivers, right from next month, you will accept the cars from the suburbs of Rome coming into the city centre, whether you like it or not, just as we take it for granted that we can get a cab from Croydon in central London. I apologise for those who are outside of England watching this. But they could pass those laws very, very quickly if they wished. And the message it would send would be tremendous if that particular example was to be followed through, because that is a particularly high-profile case at the moment in Italy.
So you're saying it's about time the conversation has shifted to growth and how to make Europe grow?
Absolutely. I mean, the core of the problem is a current account imbalance between private sector savings in the north and public sector spending in the south, by which I mean your current account is the sum of what the state and public sector saves and whatever. And we need to make sure that the north is no longer continuing to build up these huge current account surpluses, which they do because they are producing the goods that the southern people want, whether governments or households, but the southerners aren't producing the goods that the northerners want. Now, you can either say to the northerners, stop being so productive, which would go in the face of all economic understanding, or you say to the south, be productive, compete with the north, and that way the north has a lower current account surplus, we don't have these imbalances, and so on.
Tom, how much is China slowing?
Well, we're penciling in perhaps 8% growth as an annualized rate in the first half of this year, which by global standard is still pretty racy. By recent Chinese growth, it's obviously a disappointment for those who are looking for the 10% or so. I think one should take into account near and medium-term factors. The near-term factor is that as we see banks required to hold less capital behind, a reduction of monetary conditions, easing of monetary conditions, I think we are likely to see more people buy into the sort of 8% plus area, and fears of a hard landing dissipate. Medium term, growth shouldn't carry on at 10% indefinitely, because the base level is rising all the time. Now, except an awful lot of China is still poor. But I think there are a lot of economists who would say really by 2015, 16, we 6-7% would be a more normal growth rate. And indeed, we've been indicated that by the government towards the end of last year.
So China is then picking up the slack from a potential recession in the Eurozone? Or not, on a global basis?
If going from sort of 10 to 8 is picking up the slack, then so be it. It's a soft picking up compared to where we had been hoping. Perhaps this time last year we'd be hoping for 10% in China.
And as investors, what's our best way in 2012, Tom, of taking advantage of growth of around 8%, which, as you say, isn't as good as 9 or 10, but, you know, it's something.
It's not, but it's better, I think, than many analysts had been expecting. And I should add, there are still a lot of people who are expecting below 8% within that. After a terrible 2011 on Chinese stocks, I do think they are interesting. My preference is to be a bit cowardly on this and go via the Hong Kong, not go directly into the Shanghai market. And I think we can find value, especially for those who are willing to sit for the long term. The long-term growth story for the next 10 years in China is going to persist. It's not till 2027 when the number of workers begins to shrink. So I think we have between now and 2027 to still consider China as a strong emerging market growth play. And that's a long time by most investor standards.
I'm going to look at the dollar side of the euro-dollar equation and the US economy as a whole. You say, yes, recent data has surprised in the US, but this is not a return to a normal cycle. But is it enough to boost earnings? Is it enough to lift equity prices?
We think yes. We are overweight US within our global equity portfolios, multi-asset portfolios. And that's because we are seeing perhaps between 3.5–4% growth in annualized rate that's going to come in for the fourth quarter. So that means a much stronger second half than we had anticipated just in October, November. And so we now know that fears of a double dip that we entertained in the autumn were totally misplaced. And I don't think that's come through into equity valuations. Now, I know there are people who say, you can look at the cheap PEs, but that's meaningless. Look at the Schiller PE and scale yourself witless. But I have my arguments against that Schiller PE, and I do believe US stocks are cheap on a PE basis and on a yield basis. My query, if you like, is about profit margins. Profit margins, according to Andrew Smithers' research, are about 36% at the moment. That's a cyclical high. Now, you do ask yourself, can profit margins be maintained as the economy picks up steam and companies hire more people? Will you see a dent in the profit margins? It's always normal to see good profit margins at the upturn of a recovery because you're using the same number of people to sell more goods. But as the economy picks up, profit margins tend to get eaten into, and we don't know the extent to which that will happen.
So what returns, Tom, should we be content with in 2012? Give me a number.
Well, if we could get the 17 that we got on a year-on-year basis at the end of the third quarter results, that would be lovely. I'm not so optimistic. I don't think the boom in capital expenditure that we saw in the second half of last year is going to be maintained. If we can get double-digit, I'd be happy.
So when it comes to corporate earnings that we're going to start hearing more and more of, you say we should watch out for profit margins. What else can we expect?
Well, what I'm rather hoping for is a boom in consumer spending. Now, so far, analysing the third quarter data, we see CapEx and consumer were strong drivers. If we're right and CapEx fades away a little because it's had a strong run, then we're looking to the consumer to pick up the slack.
But this is a big if, isn't it? Because the housing market is still in the doldrums. Most people are underwater in their homes. Will the US consumer really come back?
Lindsay, you're absolutely right. And really what we want to see is somebody listening to the New York Fed is just one of several institutions that have recently come out and said, for goodness sake, do something about all the negative equity. By our reckoning, perhaps 2.4 trillion of the US mortgage, of the 2.4 trillion outstanding debt on the mortgage market. That makes up about 20% of total mortgages. That's a huge amount of mortgages that are underwater in the States. Something needs to be done. We need to have an initiative that allows people to rebuild their life despite having that debt. Now, I know that's anathema, that's the right word, to the Republican Party, to allow people to walk away from debt that they've taken on.
Yeah.
But something needs to be done so people and small businesses can start borrowing again and rebuilding the American economy.
I've just got a strategy question for you, because some of your counterparts at other banks are they're talking about a contrarian investment strategy where they see US stocks actually underperforming European stocks. And the basic thesis is that Europe could solve its debt crisis this year, in which case you could get a huge increase in European stocks. What do you say to them?
Yeah, I'd say Europe could solve its debt crisis.
Could, being the operative word.
I know, I'm being flippant. Hopefully by the second half of this year we will see a resolution in Europe. The main stumbling blocks are France will not cede the sovereignty that's necessary for a transfer union, and Germany is reluctant to pay for it. Those are the two big stumbling blocks that we need to see for a transfer union, which if we were to have, would solve the crisis.
Big risk outside of Europe, non-Europe risk. What's the big non-Europe risk in 2012, globally here?
We've discussed the possibility of a China hard landing, which we discount. I think there is also perhaps the impact of weaker GDP growth in the West than we're forecasting, leading through to a fall-off in commodity prices with a knock-on effect to commodity producers, which will hurt the emerging market story. Now, I think that would only be temporary. I think long-term, the commodity prices look like they're going to rebound because of tight supply-demand dynamics. But I think sort of a sudden fall-off in commodity prices would be a nasty shock to some of the emerging markets.
Tom, thank you very much for joining us today. Tom Elliott there,
Thanks,
global
Tom.
strategist with JPMorgan Asset Management. Thanks for joining us today.